Hey everyone, it's your boy Dayo, D-A-Y-O Dayo from Frunkla.com, F-R-U-N-K-L-A.com. So today I would like to talk about Benchline analyst Tony Sacconaghi with his price target of 900 US dollars. According to him, despite our relatively bullish stance on electric vehicle evolution and structural advantages we believe Tesla may hold, we find it difficult to justify Tesla's current valuation even under our most bullish imaginative scenarios. Alright guys, not to talk too much. I will also remind you guys about the earning call last week that happened last week after Tesla posted a positive Q2, and this guy got to ask Elon Musk and the CFO of Tesla two questions. The first question he asked was, you mentioned you were pleased with PTI margin progress and expected to achieve industry-leading operating margins in time. Could you shed more light on that? What market? How much will EV tax credits contribute to that margin? For those of us that don't know what tax credit is all about, today the electric car tax credit provides a dollar for dollar reduction to your income tax bill. That means that a 7,500 US dollars tax credit would save you 7,500 US dollars in taxes. This shows up, it could show up as part of your refund or as a reduction of the amount of taxes you would otherwise pay. So as a follow-up question, Sacconaghi asked Elon Musk and CFO once again. This is the follow-up question. How do you think about the trade-off between the emission of the company, open bracket, trying to make cars more affordable and broader, close bracket, and also trying to achieve best margins in the industry? So guys, these are the two questions from this bearish analyst with a price target of 900 US dollars. And I would like to play this clip for you guys now so you could listen to how Elon Musk and the CFO of Tesla answered him. Enjoy guys. I remain your boy, the AYO. Please, if you're new on this channel, please subscribe and hit the like button so as many Tesla investors as possible can see this video and listen to this question and answer. Thank you guys. Bye bye.
Will come from Tony Sacconaghi with Bernstein. Please go ahead.
Yes, thank you. You mentioned in the slide deck a couple of times that you were pleased with gross margin, with PTI margin progress, and you expected to achieve industry-leading operating margins over time. Maybe you could shed a little light on that. You know, industry-leading for luxury vendors is 8 to 10% PTI. For Porsche, who's smaller, it's 17. For mass market vendors, it's 5 to 8. What do we think about, and how much ultimately do you believe that EV credits will contribute to that margin? Because I know your margin's been 5% over the last 12 months, but it's actually less than 1% excluding EV credits. So it's a four-point contribution right now. How do we think about ultimately what industry-leading margins are, and how much of that you think is coming from EV credits, regulatory credits? And I have a follow-up, please.
Sure. I've mentioned this before in terms of regulatory credits. You know, we manage the business, or said differently, we don't manage the business with the assumption that regulatory credits will contribute in a significant way to the future. I do expect regulatory credit revenue to double in 2020 relative to 2019, and it'll continue for some period of time, but eventually the stream of regulatory credits will reduce.
Yes, I mean, it's worth noting that buyers of our car in the U.S. receive zero federal tax credit, whereas many of our competitors they get a $7,500 tax credit, and yet our sales have continued to do well.
Yeah, and so what we see is a continued decline in the cost to produce, manufacture, and distribute our cars. That cost curve, even for mature products like the S and the X, continues to come down as we do work on that. Model 3, which is our second most mature product, that continues to come down. You then layer on top of that, as Elon was discussing earlier, the potential for software-based revenue, particularly full self-driving. You know, there's the revenue recognition portion of that we have today. You know, that will expand as we release more features, and then you can layer on top of that in the future revenue from a ride-hailing network. Operating expenses continue to come down and become more efficient as a percentage of revenue. there's still incredible opportunity there that we're working on, particularly on how customers interact with the company from sales and service, and what their flow is and how we get cars to them. So we continue to see efficiencies there. So in the medium term here, what our modeling shows is in the low teens operating margin level, and I think there continues to be opportunity to drive that up. So I hear your point on the 5% and the 1%. We're on a bit of a journey here, and we're continuing to make progress.
Thank you. And if I could just follow up, Elon, you've talked a lot about the mission of the company and really trying to drive EV adoption globally. So how do you think about that trade-off between driving towards industry-leading profitability, yet trying to make your cars more affordable and broader? It feels like historically you've always picked the path of, I'd rather drive more growth and more adoption, because ultimately that's the mission of the company, and we even saw it a little bit this quarter with price reductions. You could have probably kept price where it is, sold some units, and had better profits, but that's been an ongoing choice that Tesla as a company has made. So how do you personally think about that trade-off between, even if you were to get to industry-leading margins, wouldn't you be inclined to give more of that back to drive a greater adoption more quickly?
Well, I think we actually achieve both when you factor in autonomy. I think we can go way beyond industry margins and have the car be affordable to more and more people, and eventually, almost everyone when factoring in autonomy. But that is really a mega game changer, giga game changer. But I mean, it is important for people to distinguish between two things. There's value for money that a product has, and then there's affordability. And even if you rail value for money and have value for money like infinite, if people do not have enough money in the bank account to buy the car, they simply cannot. So then you just have this like awesome thing that nobody can buy. So it is important to make the car affordable. We will not succeed in our mission if we do not make the cars affordable. Like, the thing that bugs me the most about where we are right now is that our cars are not affordable enough. We need to fix that. We are making progress in that regard, just sort of steadily making progress. Like we need to, not go bankrupt. Obviously, that's important because that will fail in our mission. But we're not trying to be super profitable either. Obviously, we're like, profitability is like 1% or something. This 1 or 2%. It's not crazy. Last quarter was only 0.1%. We want to be profitable. Like, I think we want to be like slightly profitable and maximize growth and make the cars as affordable as possible. That's like what we're trying to achieve.
Thank you. Let's go to the next question, please.